Today's For Your Benefit educational opportunity is about health savings accounts. Let's learn more.
So what is an HSA? Well, a health savings account is a pre-tax account that you own that you can use to pay for eligible medical, dental, and vision expenses now and in the future. In order to put money into a health savings account, you must be in a qualified high deductible health plan. You own the account. It's yours forever and ever and ever. It stays with you between jobs and into retirement. You even name a beneficiary for it, just like any other asset. Oftentimes, the premiums for high deductible health savings account plans are typically lower than other plans, traditional plans. And you use some of that savings to put money into that health savings account on your behalf. This can be funded by you as the employee, as well as potentially by the employer. The employee contributions are typically done through payroll, though you can contribute to them in different ways beyond that. This is the only thing in our tax code that's triple tax advantaged, meaning money goes in tax-free, earns interest tax-free, and comes out tax-free for eligible types of expenses. As I said, you have to be enrolled in a high deductible health plan in order to contribute to a health savings account. So what is a high deductible health plan? The IRS has specific criteria that make it a qualified high deductible health plan. Some of the criteria are limited to, but not exclusively these things. A deductible that is at least $1,500 for an individual or $3,000 for a two-person or family. That's for 2023. That gets indexed and updated each year. One of the other rules is that all expenses must go towards meeting the deductible. There is no first dollar coverage for expenses. You don't have copays for things like office visits or prescription drugs. Instead, you pay the full discounted cost of those office visits or prescription drugs, and those amounts go towards meeting your deductible. The amounts that you can contribute to the health savings account each year go up each year by the IRS. These are contributions that are a combination of employer and or employee contributions. So the maximum in 2023 that you can contribute as a single person is $3,850. As a family, meaning two-person or family, that contribution maximum is $7,750. And then if you're 55 or older, you can contribute an additional $1,000 on top of each of those dollar amounts to allow you to save a little bit more towards your retirement. So how does it typically work? Most times you're going to contribute through payroll on an equal amount through the course of the year. So you elect to say $100 every 2 weeks goes out of your paycheck and gets put into your bank account. You can contribute on a larger amount up front, for example, in a lump sum. You can contribute very little to start the year and increase it as the year goes on. You have a lot of flexibility in terms of when those contributions can be made. And then just like your normal bank account, the money is only there when it's there. You can't use it unless it's there. And then through the course of the year, you're going to use those HSA dollars to pay for your health insurance deductible, as well as other medical, dental, and vision expenses. As I said before, what you don't spend rolls over from year to year to year and continues to grow. There are no use it or lose it rules with health savings accounts. Who's eligible to contribute to an HSA? And notice I said contribute, because you can continue to use the dollars that you have in your health savings account for the rest of your life, even if you're not able to contribute to it anymore. But in order to contribute to the health savings account, you have to be enrolled in that high deductible health plan, as we said. You cannot be enrolled in Medicare or 6 months prior if you're a late enrollee to Medicare. You can't be enrolled in Medicaid, TRICARE, or even some VA services that you've had maybe in the last 3 months. There are some exceptions to that rule. You also cannot be covered by another non-high deductible health plan coverage. That typically means either a spouse's health plan. You can't be dually covered under a spouse's health plan and your employer's health plan unless those are both traditional health plans or they're both high deductible health plans. You also cannot contribute to a regular health flexible spending account and a health savings account. You have to choose which pre-tax account makes the most sense for you. There are limited purpose flexible spending accounts for dental and vision expenses, as well as dependent care FSAs for daycare expenses as well. Lastly, you cannot be another person's dependent to contribute to an HSA. But who can you use those dollars for? You can certainly use your HSA dollars for your own claims and expenses. You can use them for a spouse's expenses as well, even if that spouse is not covered by your employer's health plan. You cannot use your HSA dollars for a domestic partner unless that domestic partner happens to also be a tax dependent. Dependents, you can use your HSA dollars for your tax dependents. Adult children who are 18 to 26 may be covered by the health insurance plan itself, but unless they're tax dependent, you cannot use your HSA dollars to pay for their expenses. They can open their own HSA if they'd like. Minor children of a divorce, if you and your ex trade years on who can claim the kids on the taxes, they still count as your tax dependent for health savings account purposes. As I said, qualified medical expenses are considered pre-tax in a health savings account. The IRS gives us a very clear definition of what is an eligible expense. It's expenses primarily to treat or prevent a physical or mental defect or illness. That's not the most clear-cut definition in the world, but as you'll see on the next slide, it's fairly logical and makes sense once we walk through some of those. You can use your HSA dollars for ineligible expenses, but please know that you do pay an income tax on those dollars as well as a 20% penalty, though that 20% penalty does go away after you turn age 65. As I said, most of the expenses are fairly common and logical. It's all the care that would have gone towards your medical plan, so things like office visits, deductible expenses, hospitalization, prescription drugs, etc., as well as over-the-counter drugs. Those over-the-counter drugs no longer need a prescription. You can purchase those without a prescription now. Menstrual products were newly added recently as well as medically necessary dental and vision care. Then in addition to these day-to-day expenses that you may purchase, because the money in your HSA rolls over from year to year to year, it's not just a checking account for you to use to pay for those expenses that we mentioned already. It's also part of your long-term financial strategy. You can use your HSA dollars to pay for certain insurance premiums later in life. For example, COBRA continuation premiums. If you've left an employer, they've given you the COBRA continuation letter that told you how much it would be to continue that insurance for a while. You looked at it and probably thought that was very expensive. Well, it is, but if you find yourself in between jobs or you're close to age 65 and going on Medicare and you need to cover yourself for 6 months, 12 months under COBRA continuation, you can use your HSA dollars to pay for those COBRA premiums. You can also purchase long-term care insurance if you can find it, as well as even using the HSA dollars to pay for certain Medicare supplements once you turn age 65. And that's in addition to being able to continue to use your HSA dollars for all those other expenses we already mentioned. Some expenses that are thought to be eligible but are not: other insurance premiums, for example, a spouse's insurance premiums or an individual life insurance premium, those are not eligible expenses. Purely cosmetic surgery is not eligible. However, reconstruction after mastectomy, for example, or if you're in a bad car accident and you need some cosmetic surgery, those sorts of expenses are eligible, but purely cosmetic, just for purposes of the nips and tucks and things that people do sometimes, those are not eligible. Pet expenses generally are not eligible, nor are expenses covered by another insurance plan or other non-medically necessary items. So who keeps track of all of this? Well, this is between you and the IRS. Through the course of the year, as you have expenses, you're going to save the receipts that you have, either in an envelope, a folder. I take a picture of them with my phone. You're going to save those throughout the course of the year so that when you go to file your taxes, you're going to get what's called a 1099 SA, or savings account, from the bank. And it's going to say, I spent $800 out of my health savings account this year. I look back through my receipts and say, yes, I've got $800 worth of eligible expenses. Check the box on my taxes for pre-tax, and I'm done. Or maybe I have $600 worth of expenses that are eligible. I also have $200 that are not because I was at Walmart one day and I had a flat tire. I only had my HSA card on me, so I bought a tire. So what do I do about that? Well, you can either find $200 worth of other expenses to offset that tire, or you can mark the tax box on when you file your taxes and say that was an ineligible expense. You pay your income tax on it, you pay your 20% penalty on it, and as long as you're following those rules, everything's good. The banking arrangements, typically your employer will set up a default banking relationship for you. Most times you'll receive a debit card from that bank to pay for expenses. You can also order checks from places like Amazon or Vistaprint, etc. And you might use those to pay monthly payments for a hospital bill, for example, pay yourself back if you dipped into your personal savings, pay your credit card if you put something on a credit card. Same purpose for accessing the ATMs. So some of those election decisions, what are the pros about an HSA and what are some of the cons? Some of the pros are they typically have lower premium costs. What comes out of your paycheck every pay period to pay for the plan that you're enrolled in? Typically, the health savings account high deductible plans are less expensive. You have the ability to save money now and in the future pre-tax and in that health savings account to pay for those expenses in the future. You also have full control over your healthcare expenses. And one of the ideas of a high deductible health plan with health savings account is to make you a better consumer of healthcare. So you have control over all the dollars that are expended to pay for that care. Some of the cons: you must pay for all of your expenses up front in order to meet that deductible, even if those funds aren't yet in your health savings account. So especially early in a year where maybe money hasn't built up into that health savings account yet, that can cause a problem and a hardship for some folks. So make sure you're paying attention to that as to whether it makes sense for you. When we look at medical plans, oftentimes you'll have the ability to set up a payment plan with the hospital. You'll be able to negotiate the cost of that care with the hospital. You have some options. When we get to prescription drugs, though, when you go to pick up that prescription drug, if that prescription drug is $80, $200, $3,000, you have to be willing and able to pay for that prescription drug at the time that it occurs. And that can cause a hardship for some people. So make sure you know what the cost of that prescription drug that you take is. You can utilize services like goodrx.com to see what the cost of that prescription drug is. You can shop around for those prescription drugs to find the best deal. You can look for coupons and rebates from the pharmaceutical company on some of those drugs, as well as talking to your doctor and pharmacist about samples, for example. But the two types of expenses make a big difference in whether an HSA plan makes sense for you. If you have an expensive prescription drug that you can't pay for at the time that you first start in the plan, you're going to have to find a way to pay for those drugs. I want to thank you for your time. If you have any further questions about health savings accounts, you can contact your relationship manager at Rose Street Advisors, or you can contact us generally at info@rosestreetadvisors.com or at 269-552-3200. Thank you for your time.